So there's certainly a lot to talk about here. We had on Matt Stoller last night as a ardent and vocal critic of what the Biden administration just did. And as we promised, we would have on tonight someone with a different view, somebody who believed that federal government action was necessary, not to protect rich people, but to protect the banking system as a whole. He is the Silicon Valley venture capitalist David Sacks, who's an entrepreneur, an investor, and an author. He was the founding chief operating officer and product leader of PayPal way back in the day, and went on to invest in some of the biggest names in tech, including Facebook and Uber. He's now a venture capitalist and a Silicon Valley thought leader. He has a podcast called the All In Podcast, which has become very widely watched and very popular. He's an outspoken advocate, not just on banking issues, but on many issues, including foreign policy as well. I've been on his podcast before, and I'm really delighted that he is now joining our show to talk about this obviously critical issue. David, good evening. Thanks so much for taking the time to chat.
Yeah, good to be here. Good to be with you.
Absolutely. So I want to obviously talk about the merit of the debate that led up to the government action and then the merit of the terms itself. But before I get into that, I want to talk a little bit about the politics of what just happened. As I'm sure you recall, most people, unfortunately, our age recall, because we lived through it, the 2008 financial crisis, in which there was a lot of very intense anger over the perception, at least, the federal government immediately acted to protect the country's richest people who benefited for years off the system. And then when the recklessness caused the collapse, they didn't pay any price, but to the contrary, they were saved with taxpayer money. And it seems like to a lot of people, even though there are important differences that we'll get into, some of which I mentioned, this is kind of a repeat in that the world's richest people on the other side of the coast, on the West Coast in Silicon Valley, had their personal banks suddenly imperiled. They called on the federal government to save their deposits. And even though the shareholders and the bondholders and the executives got wiped out, the depositors got protected. Do you at least understand the perception that what keeps happening is that rich people benefit when they make winning bets and then have the government come in and save them when they make losing ones?
Yeah, absolutely. I understand that story and that pattern, and I understand that's why I'm on the hard end of this debate. I mean, I've been tweeting for a few days now, and there's a very angry mob of people fighting me on this, so I completely get it. But I think there are important differences with 2008. And I think a good place to start is, you're right, in 2008, the banking system was in peril. We were at risk of systemic failure. And when the Fed did intervene in that case, there weren't any bondholders or stockholders who were wiped out. And that was wrong. But this case is a little different. In this case, nobody's bailing out SVB. Okay, the bondholders are getting wiped out, the stockholders are being wiped out, the executive stock options are being wiped out. The CEO is going to be in litigation, and the exec team are going to be in litigation for years. They may have their stock sales clawed back. So nobody who caused this mess is basically benefiting. Their lives are basically ruined. Their reputations are disgraced. The question is depositors and what you do with deposits. And I noticed in your introduction, you described the behavior that the depositors of SVB engaged in as gambling, like they'd been in a casino. And this is where I would push back a little bit.
To be clear, I was referring to the people who ran the bank, not necessarily the depositors, but okay. Go ahead.
Yeah, fair enough. And I think you understand the situation. But it's a very common description now in the media. I think the common narrative is that somehow the depositors or the customers of SVB were doing something inordinately risky. And I think it's important to understand that startups may be risky, but they didn't. That's not why SVB failed. SVB failed because it basically invested in a bunch of mortgage bonds that went toxic, and the startups had nothing to do with that. Okay, the only decision that startups made was to basically open a checking account or open a deposit account at SVB, and so the question comes down to, are you going to hold depositors liable for basically a bank that had a regulatory seal of approval, that was blessed by the FTC, that passed all its regulatory exams? In fact, it had an A rating from Moody's just a week ago. Are you going to hold depositors liable in that situation? And my view is no. And I think if we could just separate that issue, then I think everyone would understand that if we had a different set of depositors here, no one would even be debating this. If it had been 40,000 farmers, for example, small business farms who were depositors, and this bank wasn't called Silicon Valley Bank, but Farmers Bank, I don't think we'd be debating for a second that those depositors shouldn't be responsible for a regulatory failure, because this is what this was. And I think it's because there's so much animosity towards tech and the tech industry. And I get it, tech can be insufferable. And especially for people on our side of the aisle, they're repressing speech and doing woke, stupid stuff that we hate. So I totally get the anger. But I do think that if the reason we're holding depositors liable here is because we just don't like these depositors, I think that's a really bad policy.
So I want to get into all of that. And before I do, though, I've seen some conflicting reporting online about the specifics of the actual receivership and the guarantee, and maybe we haven't seen enough to say for sure. There seems to be conflict about whether the bondholders really are getting wiped out, in part because there seems to be, in the bond market, some value still being assigned to the bonds that were being held by the bank. Is that something you can shed light on one way or the other definitively?
Well, I think the reason why there's a question about that is because we don't actually know if SVB was fully insolvent or not. So what happened was that there was a run on the bank because I think the bank engaged in very poor risk management. We can certainly discuss that. And their communications were terrible. And so because of that, there was I think, rational and legitimate fear that the bank might fail. And so basically depositors sought to take their money out. At the end of the day, until all of SVB's assets are sold off and liquidated, we don't really know if their balance sheet it might ultimately have 100 cents on the dollar. It might have 90 cents on the dollar. It might have 85 cents on the dollar. I've seen analyses all over the place. This backstop by the federal government might not cost taxpayers aren't on the hook anyway. We can talk about that, but it might not even cost the FDIC anything. So we just don't know until all of SVB's assets are liquidated what the real balance sheet looks like.
So I get your point completely that if this weren't called Silicon Valley Bank, if this were called Signature Bank, if this weren't a bank serving Silicon Valley tech startups, but instead, any other industry, the kind of reflexive reaction would be different. At the same time, it is hard not to notice that it is Silicon Valley Bank. And I think a lot of people are wondering, and I definitely include myself in that, is it just like a giant coincidence that the first bank where there was a bank run and that failed in this way just so happened to be Silicon Valley Bank, that is the most intimately connected with entrepreneurs from Silicon Valley and funders, very sophisticated and wealthy people? Or is there something specific about this bank and the way that it conducted its business that caused this to happen?
Well, sort of, and let me explain that in a second. But you'll notice that Signature Bank, basically the run on Signature Bank started on Friday, and the regulators seized it on Sunday. And there were a bunch of other banks under pressure as well, like you mentioned, First Republic, even Schwab. Trading in Schwab, a $100 billion giant, was halted on Monday, and there were a dozen other regional banks that were under enormous stress. If Signature Bank had gone a day before SVB instead of a day after, again, I don't think we'd be having the same debate. But to answer your question directly, let me just explain why this whole thing happened. And you really have to go back to Monday of last week. That's when the chair of the FDIC gave testimony explaining that there were $620 billion of unrealized losses in the banking system. Now, what does that mean? It means that banks, and especially regional banks, bought long-dated treasuries and long-dated mortgage bonds, basically 10-year treasuries, 10-year mortgage bonds. And they were sitting on those. And over the last year, because of the spike in interest rates, which was caused by the Fed's reaction to inflation, the face value of those bonds had plummeted. They became toxic assets. They were never supposed to be toxic assets. T-bills and mortgage bonds are supposed to be the safest assets there are. That's why SVB had an A rating from Moody's. Nobody thought they were getting into a high-risk situation. This is not like in 2008 where there's all these complicated derivatives nobody can understand. They thought they were buying safe assets. But what happened is that because SVB caters to a community startups who are volatile in terms of their cash needs, there were more drawdowns on deposits. And because because there was a near-term drawdown in deposits and they had $80 billion invested in 10-year bonds, there was what you would call a duration mismatch. And they would need to sell those bonds to pay off withdrawals. And because of I think a really stupid regulatory rule that says that banks don't have to recognize losses on bonds until they sell them, that basically what was going to happen is that SVB announced that, hey, we're going to have to start selling off these bonds to pay off these withdrawals. And then all of a sudden you're going to see that we have these giant unrealized losses and we don't have enough regulatory capital. And that's when they announced we need to do an emergency fundraise. That happened on Wednesday, and then that is what triggered the run on the bank on Thursdays. Everyone wondered whether they were insolvent or not. So there's a lot to unpack there. I don't, hopefully that wasn't like too technical, but the bottom line is that what SVB did is being done and was done by banks all over the country, which is they simply bought T-bills and mortgage bonds that became toxic. And again, you have to go back to why. And fundamentally, the reason why is because we had the worst inflation in 40 years. And that led to the fastest spike in interest rates we've basically ever seen over the past year. So that is why they got caught off sides. And so I think, listen, I think that
I remember, even as someone who doesn't pay a huge amount of attention to such matters, that this increase in interest rates as a way of staving off inflation was very vocally telegraphed. I mean, it's not like the bank executives and managers were taken by complete surprise. It was within their capacity, had they been managing this bank responsibly, to have adopted, say, less riskier or less high risk, high reward strategies for adapting to what they knew were going to be these interest rates as a way of staying off inflation. Isn't that a fair critique of the bank?
Totally. And I'm not defending the bank. I think they engaged in very poor, very foolish risk management. They deserve to be wiped out. The CEO is going to be in the hot seat for years, probably. They deserve maybe to have stock options clawed back. That bank deserves to fail. So they engage in very poor risk management. But let's get to the heart of what they did wrong. If you had to pinpoint a single thing, it actually wasn't wokeness. And I loathe wokeness as much as anybody on earth. This is like the Republican narrative that's emerged because they were too woke. Listen, if wokeness was the problem, the whole Fortune 500 would be bankrupt right now, okay? All these banks are woke. The problem was not that. It was that, if you want to know the truth, is they believed that inflation would be transitory. When Biden, Yellen, and Powell said, basically in 2021, that don't worry about inflation, it's going to be transitory, they believed them. They listened to them. And they didn't basically buy the hedge on interest rates. They should have. Now, I think that was incredibly stupid. I never believed Biden, Yellen, and Powell. And you didn't believe Biden, Yellen, and Powell because we're skeptical. But that was really their mistake. And I think that Washington really needs to take some responsibility here for creating this whole mess. If it wasn't for the Biden administration spending trillions and trillions in an unprecedented way, starting in 2021, the economy was already hot. It had already recovered from COVID. And Biden started printing trillions, and the Fed kept going with QE and printing even more. And that led to this unprecedented wave of inflation. That led to the spike in interest rates. And that is why all these banks have so many toxic assets on their books. So ultimately, this is a banking crisis that originates first and foremost in Washington. They're the ones who deserve the blame here. That's who Republicans should be training their fire on. And it's really stupid to be training your fire on the depositors. The depositors, listen, there's three groups of people in this whole mess. There's the Washington policymakers, there's the management of the bank, and then there's the depositors. The least culpable group are the depositors. They didn't have any agency over any of this. They just made a decision over where to open a checking account. Now, I don't know about you, but when I go open a checking account that's been blessed by Moody's and the FDIC, I'm not in a position to assess that bank's balance sheet. How am I supposed to know if the balance sheet is healthy or not? That's what I expect the Feds to do. That's what the FDIC is supposed to do. How in the world am I supposed to figure that out? I mean, Bill Ackman, who's a super sophisticated investor, and I'm an investor too, he says he can't figure it out. I can't figure it out. Nobody can figure it out. So we need regulators. We need regulators to tell us when a bank is safe.
Okay, great. So then here I think is where we... Thanks for watching this clip from System Update. Catch our full shows for free, live weekdays at 7 p.m. Eastern on Rumble, and join our locals community at greenwald.locals.com for all of my written journalism, exclusive after-show Q&As, and more.